Okay, hello everyone. I'm Hadas from the Popular Investor team. Here with us we have Jeppe Kirk Bonde for his Q3 conference call, which I'm sure will be fascinating and productive as always.
Thank you very much, Hades. So welcome everybody to the Q3 22 quarterly call. If you want to use this presentation for anything, then please read what it says at the bottom of this slide carefully. So the agenda for this presentation is that I'm going to talk about my background, my investment strategy, my portfolio, and then go through the questions. Since 2013, I've had an average annual return of 27%, and that's better than anyone you could really fairly compare with. I have however, also had a very good return to risk profile along the way. I got my degree in finance many years ago and then started work as a management consultant. Mainly, I had my career in London. One of the products I worked with the most was valuations, so building large financial models to calculate what a company is really worth. Now, as I was making more money than I was spending, I started to invest my money. I just continued to do really well with my investments on eToro, and eventually I stopped doing management consulting to focus only on managing my investments on eToro. And today I have the most copiers on eToro. Today I don't do everything on my own. I have 5 assistants who help me. I have a really good network of people that I can trust to inform me well on complex topics. I also get strong support from eToro. I also pay a lot of money to have the best data subscriptions in the world. And finally, I'll highlight my 3 favorite experts, which are my 3 brothers. One of them, he is a computer scientist. One is an economist in the Ministry of Finance. And the last one's the CEO of a marketing company. Then my investment strategy is based on some principles that have been there all along. Firstly, I look at macroeconomics. I look for megatrends. I focus on fundamentals, understanding companies from first principles and predict what kind of cash flows they could have year after year after year. And I use all of that in order to assess what I think the company is really worth. And then I want to invest in companies I think are worth a lot more than they cost. Then I focus on the long term, and that's the most difficult one of these principles for people to understand mostly, and because it's sort of counterintuitive. You've historically been better off by focusing on the things that will really matter down the line. The best CEOs don't focus on what's on the news items this week or what seems urgent today. They keep a focus on what will matter in the long term. There's a great quote by Benjamin Graham: in the short term, the market is a voting machine. In the long term, a weighing machine. And that really means that in the short term, what matters is what people think about a company. But in the long term, what matters is how good the company actually is. Then I focus a lot on risk management. I currently have 60 different assets in the portfolio, and then I hedge against tail risks. And so for each of those, I generally like to have at least one asset I think could do very well in the if that range of scenarios were to occur. Finally, I focus on keeping fees low. I don't do any shorting. I don't use any leverage. I avoid all high fee instruments. I have a quite low trade frequency. Now, then there are some opportunity areas that I think are really good. I like companies that have organic growth, but it does not include companies that are just growing through acquisitions. I like companies that are resilient. I like companies that are profitable or at least have a quite clear path to profitability. I like companies that change strategy. Then to predict the future, a big piece is just to understand the present. If you are capable of making good purchases, if you're a smart shopper, that's sort of a big piece of the whole puzzle that you fit it in there. If you can't even do that, then understanding the rest of company and so forth is really difficult. Then I like companies that are mission driven because it can really help companies attract and keep the most hardworking, smart people without overpaying them. Then if we look at the history of investments, over the last 500 years, stocks have on average yielded 7% return on investment per year. That's equivalent to doubling your portfolio's value every decade. And then people think, oh, but how much is that after one decade? It scales quite rapidly through the centuries. And that's how someone can go from just making, the investment of 1 year's salary to having a very, very vast family fortune. Now, in the future, if you look at what kind of profitability companies have now, it's probably going to be a bit lower than that. Capital might be growing more than the total population, but it's still the best asset class in my view to hold. Property has also been good historically and is still probably fine. Bonds have been decent historically, but are now not looking that great. Commodities have sort of not done much through history for the core reason that if you had a gold bar during the Roman Empire and you kept that gold bar, and now today you still just have one gold bar. Stocks, a company can pay out dividends every year, which can be invested into more stock. You don't really have that with commodities. Finally, currencies have not been great. With the best, most well-managed currencies in the world, we are seeing 9% inflation. So they're losing 9% value per year, even though their goal is 2% per year. So when you add that up, overall currencies haven't been that great, and I don't think now they're that great. So whenever I have a lot of excess cash, I generally try to get it invested to some stocks as fast as possible. Then if we look at the really grand drivers of economic growth through history, we can look at the physical world, the social ideas, the big ideologies, and the technologies. Firstly, we have nature, the great physical endowments we have, and we have life, especially humans. How many humans do we have in different places? The companies that have the right products for the right age segment in the right place, of course, have an advantage. Then the category of things that can really cause the most change the fastest are the social ideas and ideologies. These are just shared ideas backed up by some pieces of paper. If we believe in these, then they can help us cooperate with one another, which can help us create a lot of value. If we stop believing in this, then the cooperation can stop and a lot of value can suddenly be destroyed. Then if something is changing in how we value things, even if it's coming from the fringes of society, if it's changing at quite a high rate, then suddenly it can go, over a few years from the fringes to the mainstream and really drive a massive change in value. Then finally, we have the technologies. These are the ones that can really drive, double-digit growth for, double-digit range of years. The steam engine, the internal combustion engine, the computer, the internet, and now deep learning. But there's also amazing value over the years just from small, simple innovations, people finding ways around their house to do things in a better way, companies doing things smarter and smarter. Then from that grand perspective of drivers of economic growth, we can sort of see where is the economy today. So growth has been okay for a long time, but now it's sort of ground to a halt and even turned slightly negative. Inflation is much higher than it is the target. It's more than 40% for energy, more than 10% for food, and food is one of those budget line items that makes up a very small percentage for the rich people, but makes up a very large percentage for poor people. You can of course eat some different things. There are different ways to change habits, but people need food, and people can live many different lifestyles, but that's one thing you can't live without. So that's one really that really painful. Unemployment figures have come in better than expected, but it's probably going up, certainly based off of what companies are announcing, and interest rates are higher than they have been. The central banks, which are sort of the key actors in managing the short-term economy, they have to balance between having too high inflation and a too severe recession. If they keep the balance right, we are going to have too much inflation and a recession, but if they mismanage it, then we're going to have like way too high inflation and a recession. But there's no sort of like a win-win outcome. There is a lose-lose, and that's just a question of how bad you want that balance to be. There are some mega trends that I've identified as extra interesting. So if a company is driving one of these megatrends, then it's more likely to be found in my portfolio. I really like the nice to haves of this world. Gaming and fashion in particular. I think within this space, there are some amazing companies with the great opportunities for profitability and growth. But the nice to haves rest on the shoulders of the need to haves. And within these areas, I have some, lots of investments. Then there are some technologies that help to just make all of these better and faster. Chief of all is deep learning. The companies that have made the biggest breakthroughs in deep learning in the past few years are to be found in the portfolio. And the companies that are making the most amazing devices now are to be found in the portfolio. So when you got an industry or a group of companies and you sort of want to compare them quickly, a great way is to use multiples. So this is an example with a FANG, so Facebook, Apple, Amazon, Netflix, and Google. If we look in the top left corner, we can see that all 5 of them have amazing profit margins, except Amazon. Now, all of them, if you recall, have had double-digit growth rates, but now that growth has stagnated. These 2 top charts, the higher the better, but the 2 bottom charts, the lower the better, because they're about price. So we can see that for Meta, we're paying $12 for every dollar of profit we're getting. So one might even say that if this is the case, we should now be expecting that Meta has gone from being a growth company to being a value company. For Apple, Netflix, Google, we're paying about 20 times, so that's more. For Amazon, we're paying $100 for every dollar of profit we're getting. So we would only want to pay that much more if we think that they can keep or improve this growth rate, or maybe get their profitability up a lot. And if we look at the bottom right, we can see for every dollar of revenue that Meta has, we are paying $4. So that's quite fine. For Amazon, we're only paying $3, but they're also getting a lot less profitability out of their revenue, and they're also growing by less. So that seems sort of sensible. Now, I don't look at the data charts most of the time. I spend most of the time looking at big data tables. Then most of those data tables are updated continuously, automatically via APIs. I also have a lot of data tables that I update myself. And all of that data is synthesized and used in my analysis to value companies and to make risk analysis. And all those analyses are then used to make decisions. Now, the decisions can either be research decisions, then I analyze that, then that might give me some new insights that then cause me to do more research. And then this sort of goes around in a cycle until my decisions turn into investment decisions. And when you add up all of these decisions over time, then that's my portfolio. And if we take my portfolio and compare with the US economy, we can see for the US economy, it's not just one industry that's creating all of the economic activity, and there's also great investment opportunities across many different industries. In my portfolio, there are some industries that take up a slightly larger space. Currently, my largest investments are Centene, Leidos, and Alphabet. You can always see my total portfolio on eToro in the app or on the website. It's available for everyone to see. 2 weeks ago, I asked on eToro for people to submit questions, and so I've collected these questions. We'll go through them now, and then after these questions, I'll take some more questions from the chat. So firstly, there's a question, what is your approach to the eToro risk score? I really like that we have the eToro risk score. We have a third party providing this rather than everybody just claiming, what their risk level is, because it gives everybody a good chance to see how risky is a portfolio. The eToro risk score is calculated by using a covariance matrix. You get a score from 1 to 10. The lower, the safer. To reduce your risk on the eToro risk score, it means you have to have, different kinds of assets that are not gonna, all correlate with each other. Now, I also have my own risk framework where I'm always trying to see, can I reduce my risk? Is there a way where I only take slightly more risk but I can get a lot higher return? But before I ever make any changes to my portfolio, I always make sure that it's a good idea based off of my own risk frameworks, and it's a good idea based off of the eToro risk framework. And I think it makes good sense to have your own risk framework as well as have one provided by an external party. And I also sometimes use other external parties as well. Then how does your valuation model work? I can't really get into detail about how I look at companies in a numerical way. These are financial models I've been building on for more than 10 years. If I continue to work as hard as I can to improve the way that I look at the world through my models, then I accelerate away from the competition. I'm building a proprietary thing here that gives me a competitive advantage. If I give that away, then I don't have that competitive advantage. I have to keep some of my sort of greatest insights to myself, unfortunately. What's your take on the current uncertain market conditions? In general, people always think that now is a very uncertain time, and they misremember how uncertain previous times felt. If you look at how much war there's been in the world, like from the First World War, the Second World War, all these times things have felt way more uncertain than they do just because there is a conflict with some tens of thousands of casualties in Russia, Ukraine, and some saber rattling over Taiwan. We are at a relatively peaceful time in historical context. We are, according to the old definition, in a recession. But if you think about the level of uncertainty, the range at which how bad this recession can be, I think, is more sort of narrow. When COVID hit, that was much more uncertain. So I don't think the uncertainty level is much higher than it usually is. And I think the big risks are something I think people can design a portfolio where if bad things happen, overall, pretty nice state of affairs. You also got to remember that now stock prices are lower than they were at the beginning of the year. So while things may seem riskier, you're also getting slight discount. So it's sort of an okay time in a historical context. Do you expect a rally on stocks in what's left of the year? I think it's more likely than not, but it's not what I base my investments off of. When I invest in a company, it's based off of a long analysis that this company is going to do well through its entire lifetime. Could be a company that I think will not do well for many, many years. Then it'll start to do very well. Not in terms of their stock price, but the company itself, how much cash flow it can really deliver year by year. That's what I'm interested in. And when I think a company is a great investment, what I am implicitly saying is that others are on weighted average wrong about this stock. When I was investing in Tesla in 2016, I didn't buy Tesla because I thought, in 3 months, other people are going to hear about Tesla in the news and they're going to love it and bid up the stock. No, I thought this is an amazing company. company. One day it could be the biggest company in the world. At the time, they only cost 5 billion. I bought more every time Elon Musk said something stupid, you know. But I was never with the idea that, oh, this year I'm going to make a lot of money on this stock. It was with the idea that I am buying more of this amazing company, and now I own a bigger share of this company. And if this company one day becomes a very, very big profitable company, I'll be happy that I own a big share of it. Now, as the price then came up to match my valuation, I sold off most of my position because I wanted to invest in something else instead that I thought had a better valuation compared to its price. So that might very well happen. But I'm never buying something because I believe that the stocks are going to rally this year. When is the best time to copy? The best time to invest is as soon as possible, and the soonest possible is now. If you have a lot of cash, it's probably worthwhile to get some of that cash turned into some stocks. There's a slight advantage to opening the copy on a weekday between 3 and 4 GMT, as that's when the most stock exchanges are concurrently open, but that's really a minor point. The bigger point is that if you have a lot of excess cash lying around, the best thing is probably to get it invested into some stocks as soon as possible. Is it best to buy stocks now when they are low, or wait for the market to begin to recover? That's generally a sort of a bad way of thinking about when to invest. Many people are just never going to invest. Whether stocks have gone up or down recently, that probably correlates with whether there have been some good news. So yeah, maybe now the world looks better and you're paying more. Maybe the world looks worse, but you're paying less. In both cases, if you know nothing else, you know that you're getting the weighted average market deal that me and many other investors and hedge funds and banks and whatnot have bid the prices up and down to be at. So you're going to be buying the stocks at the market price. Then if you have a lot of analysis behind your decisions, maybe you can get some that you think are trading actually at a market price that's below their intrinsic value and make a what's called an alpha, an excess return from your analysis. Will you make a program to teach new investors about trading? I love teaching and explaining things. I grew up with my little brothers always asking me questions like, Jeppe, what is inflation? Jeppe, what is this? So I sort of had to learn how to explain things in a good way. And I think there are a lot of complex topics that I probably could explain in a good way, but I also prioritize my time quite carefully. My primary duty is to be a good investor. And so it's sort of probably not something that I will do within the next year at least. But if I can find a way where maybe my assistants could do more of the work to alleviate my time on such a project, then it would be something I would consider. Can you comment on the implications of the Taiwan situation? So I certainly can. Maybe my opinions will change after my meeting on Taiwan tomorrow. China will by far do best by pursuing a globalist, peaceful agenda. Over the last 30 years, one of the biggest winners in the world of globalization has been China. And so it's not the most realistic outcome that they're going to choose, a bad strategy from one of these other categories. Now, if you look at in terms of, what was really the level of provocation here with Nancy Pelosi visiting Taiwan, sending a politician to visit a place that's not a very big provocation, and China's responded with a 4-day big military drill and breaking down some communications channels and declining to participate in a UN meeting in 3 months and so forth. So I think China has shown don't mess with us, make a big reaction, and I also think they've done sort of more than enough. I've sort of placed my assets in a way that losses in China can be made up for by gains in another place. In the worst of scenarios, some of the defense stocks can do very well. So sort of I'm quite comfortable with how the portfolio can perform even in the worst case scenarios. Thank you very much to everybody who wrote a question. Now, if you want to have any other questions, please write them in the chat, and then I'll just go and answer however many I have time for in the chat. So your portfolio versus an index fund. Who should go with you? Who with the index fund? So I don't like index fund. And if you, for instance, a lot of people think, why don't I just buy the SP500 index? Isn't this less risky? No. If you just buy the SP500, you are basically only getting American stock. You're really not getting any geographical diversification. The biggest companies in the tech sector make up a very large proportion of the SP500. So you're not even getting great diversification. Third of all, quite often when you actually see the details of the contract of the ETF or index fund you're buying, you're not even getting all 500 stocks. You're only getting a small proportion of them that's picked to sort of mimic the return of the index. Then the index funds, they constantly rebalance. So the fees are actually higher than most people think on these. So overall, it's just not the best way to build a portfolio. I think that in general, it's better, cheaper to buy many different companies from many different countries and different industries, and then have that rather than do it via an index fund on ETF. Why did you move to the UAE? So of course, because of the great weather, the amazing kebabs, everything is really, really easy here. It's in the middle of the world, so I can sort of go anywhere. I love my time in London as well, but I really also feel right now in Dubai, it's almost like having moved to New York at the beginning of the 1900s. You know, everybody's coming here. You got influencers, you meet CEOs, entrepreneurs. There's so many incredibly smart people here that you can talk to and get ideas from, and that's really amazing here. Why did you start Bonde Capital? What are the benefits of being a popular investor in eToro as a private individual? So when you are an elite pro popular investor in eToro, you have to have your own company as well. You also have to have a large amount at a minimum invested. You have to have a certificate in either wealth management or investment management, and I think you also have to have a explicit strategy that you're not allowed to change. So I didn't make up those criteria, but I think they're extremely sensible, and so I'm very happy to fulfill those. When do you rebalance your portfolio? So when I deem that it's overall necessary and something valuable to do for all copyists. I did it last time in August 2020, so it's been quite a while. Another thing that can make it happen faster is, you know, if I have had a major sort of epiphany or change of views, or, you know, certainly something that was going to be the big future, then that would make it extra likely as well that I would do a rebalancing. Do you expect another pullback in the market before it will turn more positive? So this is the sort of zigzagging of the markets that I don't really care about. I don't care about, you know, making a few percent this month or, you know, this year. I care about constantly owning the assets I think are most valuable, and I'm happy to wait around for that variable to be seen by others. Or I'm even happy if it's never seen by others, as long as I'm actually right that this company would have this kind of cash flow. Because if I own 1% of a company, I own the rights to 1% of its cash flows. If that company one day pays out a dividend, I get part of that dividend. That's what I'm focusing on. There's a lot of fear that the market has yet to hit bottom and that SP 500 may lose 10 to 20% at the end of this year. What do you think? And are you positioning yourself towards this? In any given year, markets can quite easily go up or down by 20%. If you look at the average recession in history, they've generally lasted 1 to 2 years. They've caused a few percentage points extra unemployment. They've meant a GDP decline of, you know, close to 0%. And over the course of those recessions, markets haven't actually declined much. So there might have been a decline, but then it's gone back up. But overall, it's not been that bad. There's often this sort of misunderstanding that the stock market should follow the economy. But there's a very, very fundamental flaw in that. And that is that when I say, how is the economy doing? We're talking about how the economy is doing right now. When you're buying a company, that means that you own the rights now to how this company is performing next year, the year after, but also the year after that, and the year after that, and the year after that. So if someone gave you a nice new house, but told you that you could not use the house for 2 years, but then you could use it, that does not make the house worthless. That means, okay, the house is worth less by that amount. So if you look like, you know, how did JP Morgan and Apple and so forth fare during recessions? You know, in the worst of cases, their profits have disappeared or even turned negative, but they've actually stayed okay. You can even have the very fortunate situation that a recession is exactly bad enough for a competitor to buckle under, but for the nice enterprise to stay alive, and that actually benefits them overall. As stock market investors, we are being paid an insurance premium every year for taking on this volatility. We accept that we are getting an uncertain reward. If you can accept the risk of this, then the average amount that's higher every year in the end is all that matters. So I think sort of people should find the stomach to accept that when you're investing, it can go down immediately, and that's okay. It can go further down, and that's okay, and then it can go up again, because the overall average is good, and in the very long term, it's very unlikely to be a negative. If you invested right before the financial crisis of 2008, you would still have doubled your money today. So that's sort of that's really, even if you're investing at the worst of times, it's still better than not investing. This will sound a bit silly, but I find your portfolio something that I can invest in every month. However, for a long-term investment, having such thing under the control of one man, how can you assure that all trades are conducted with good intentions? After a night out, you don't go wild with leveraging. I think that's, you can trust based off my track record of 10 years of doing this. I spent all of my time on this, and I built lots of network and tool around this. I do everything I can to invest my money the best I can. A lot of my friends and family are copying me, and so it's my great responsibility to ensure that I invest as well as I can. If one had some extra cash, would it be better to copy you 10% at a time just to average, or all in at once? So in general, it's if you have a lot of excess cash lying around, it's usually better to get most of that invested immediately, because otherwise that cash is just sitting around and losing out to inflation and not getting that steady average return. However, if the situation is that every month you have a bit more income than you are spending, then it might make sense to invest that. And then by doing this, you sort of get on the path of building a nice sizable portfolio that can, in the long run start to provide that passive income. That means that you can, retire earlier, or, give your kids a really, really nice inheritance. In terms of how much idle cash one should have, it's sort of either one should have enough cash or credit to be able to pay for likely expenses. It's part of an exercise called cash flow management, where you really think about how much cash you are likely to need, and then if you have that, then it's sort of anything beyond that. Do you still have any hopes for crypto? Yes, I think having everybody agree on using something like Bitcoin is much better. And I think if some of these sort of technological changes within the realm of crypto, they suddenly start working, and we start seeing people actually paying for day-to-day things with crypto, then I think it has a big future. When that happens, we'll see things happen extremely fast. I have a little bit of Bitcoin in the portfolio. Maybe I'd add another one at some particular time. There are certainly certain technological developments that could make it extremely interesting. How long will you stay with eToro? So hopefully forever. I have a maybe unrealistic dream, but I would like to have a total lifetime return higher than Warren Buffett one day. But I certainly have no plans to leave eToro. I have no plans to do anything else. I'm very happy just managing my investments and making the best investments that I can. How often do you make decisions on capital reallocation of your portfolio? Every day. Every day I ask myself the question, what do I want to be invested in? Quite often, the answer is the same as the day before. If I have a company that I think is worth a lot more than its cost, there was a bad announcement and I think one of their products would be less good, so now I think they're worth 3% less. Overall, that still doesn't matter. It's still a great investment. So most days, the answer to what do I want to own is the same as the day before. But there are changes. Sometimes I see a new strategy for a company that I'm invested in, and I don't like it. I have something else I want instead. So I sell it, I buy something else. And so I make these adjustments as they become necessary. What do I want to have right now? That's like the key question. Do you cover stocks that are not yet available in eToro? Yes, I will track them with less level of detail. Effectively, I automatically source data on thousands of companies, and the ones that are available on eToro generally get more scrutiny. But sometimes if a company has an important competitor, but you can't buy that stock on eToro, even if it's a private company, it still means I need to analyze that company, because if I don't know the competitor, then I don't necessarily know the company that's competing with them. What do you think about stop loss limits? I generally do not like them. I don't think that's the best way to manage one's risk. I think it's better to only invest what one can afford to lose, because you're saying if the stock drops by 20% or 50%, I'm going to sell it. But why? Imagine the following case. You have invested in a factory. Now, this factory is worth $1 billion. Now, half of the factory burns down. This company is now worth $500 million. But imagine that the stock went down by 80%. Would you want to sell it automatically at an 80% discount when the stock is only worth half as much? No, you wouldn't. You would actually want to invest more in this company. So you are programming in an automatic sell at a time where potentially you would want to buy more. So that's why I don't think stop losses or take profits are very useful.
Hi, everyone. So Jeppe will be taking the last question now.
Yeah, all right. So last question here. So can you recommend some books for new investors and traders? I recommend the academic literature. If you get a book like Investments and Portfolio Management by Bodie, Kane, and Marcus, just picking up a core university book on statistics is really good. For sort of pop science books, I like Nicholas Nassim Taleb a lot. His book, The Black Swan, is a very, very interesting one. Then I'm sure there's a lot of good stuff one can find on YouTube as well. I think the book Valuation by Goodhart, Collar and Vessels from McKinsey is a really good book. They're not like easy. They're not really for beginners, but these are really just amazing books, I would say. That was the last question we had time for. So thank you everybody very much for participating. Thank you very much for the questions that were sent in advance and the questions from the chat. And if you have any other questions, please go ahead and write to me on eToro or one of the other places. So thank you very much.